All right, welcome everybody. We'll give everyone just a few minutes to trickle on in here. Welcome to our webinar, Energy Tax Credits Plus. We got a really interesting program for you today. My name is Ian Sharples. I'm a Sustainable Housing Program Manager here at the California Housing Partnership. We're really excited to bring this program to you today. Like I mentioned, we'll just give it a couple more minutes for folks to trickle in, and then we will get started. So hang tight there. And okay, cool. I see more people coming in. Come on in, come on in. All right. Welcome for those just joining us. We're at Energy Tax Credits Plus. Fantastic program for you today. We'll give it about another minute before we get started. That way everybody has a chance to get in here. All right, all right. Still see some people coming. Very good, very good. I still see some folks joining us. Again, this is Energy Tax Credits Plus. It's a webinar being put on by the California Housing Partnership. My name is Ian Sharples. I'm a Sustainable Housing Program Manager here at the California Housing Partnership, helping to put this program on. Give it maybe 30 seconds more, then we can get started. See some folks still coming in. That's wonderful. All right, I think it's leveling off, so I'll get this started. So welcome everybody to Energy Tax Credits Plus, Renewable Energy Tax Credit Overview and updates from the new Inflation Reduction Act guidance. This is a really big topic this year. There have been a lot of changes thanks to the Inflation Reduction Act, and we're going to explore them today and see what they mean for energy tax credits. Like I mentioned before, my name is Ian Sharples. I'm a Sustainable Housing Program Manager here at the California Housing Partnership. I'm proud to help bring this program to you. We've got a fantastic information for you, and let's get started. Before we do, I want to first and foremost thank our sponsors for helping to make this program possible. We've got, first off, the Wells Fargo Foundation and our other sponsor, the Building Initiative for Low Emissions Development. I want to thank Wells Fargo for their support and their continued commitment to equitable building decarbonization for affordable housing. We really appreciate all the work that they've done in this space. And for the Building Initiative for Low Emissions Development, or BUILD program, this is a program from the California Energy Commission that synergizes well with a number of different um, decarbonization programs that are available, including the energy tax credits. So what Build can offer is Build offers up to 300 hours of no-cost technical assistance on all-electric building design. This is just free help for you to help design all-electric buildings. It's really encouraged to utilize this in conjunction with other programs and other incentives. The Build Technical Assistance Team is able to help support you throughout the entire development process, from conception through to your certificate of occupancy. And they have a lot of different educational resources on electric building design technologies. So if you've ever wondered about heat pump sizing and placement, HVAC design optimization, or envelope improvements, these are things that they can help you with. So we also want to remind everybody about the final session in our IRA training series. That'll be next Wednesday, February 14th. We'll be discussing understanding the Inflation Reduction Act's decarbonization rebate programs. That's HOMES, HERA, and EBD, with a little question mark for the EBD. We'll get into that on next Wednesday. That'll be 11:30 a.m. to 12:30 p.m. If you're registered for this, you're also registered for that one. So just use the same link. It'll be hosted by our own Andrew Dawson, Policy Advocacy Manager, and should be a good time. Let's look real quick at the webinar logistics. So, before we get into the actual program, I want to note that this meeting is being recorded. So be aware if you don't want to be recorded, you should probably drop out now, but I haven't seen anybody have any problems with that, so I think we should all be good. Questions and answers. We do have an active QA box down at the bottom of the screen. We'll be taking questions and answers at the end of the program today. Be sure to enter them there and we'll get to them. And then finally, we'll be sending out the PowerPoint deck from this presentation afterwards, along with a short survey. So please feel free to download that and fill out the survey. It'll be pretty helpful for us. So with that, I want to introduce the wonderful, incomparable, deeply knowledgeable Jesse Ozanian. He's a senior housing finance consultant here at the partnership. You can see his email there if you have any further questions. And with that, I'll let Jesse take it away.
Great. Thanks so much, Ian. Let me share my screen so I can control the PowerPoint. Just 1 second. Share. Okay, can everybody see that? Hopefully.
Yes.
Okay, great. Well, thanks. Yes, my name's Jesse Ozanian. I've been in the affordable housing industry for about 12 years now. I started as a project manager for the first 10 years, and I've been at the partnership for a little over a year and a half. So I'm very happy to be here today to talk about renewable energy tax credits. There's going to be a lot to cover in a relatively short amount of time, so I'm going to move on to the agenda. Okay, so today we're going to start out with some renewable energy tax credit basics. We're going to move into an exercise showing how you calculate the credit. The majority of the presentation will be covering renewable energy tax credit new rules, general rules, and new rules that were put in place by the passage of the Inflation Reduction Act. We're going to talk about the tax-exempt use issue. We're going to highlight some different stages of development where this tax credit might be useful. And then if we have some time at the end, we'll talk about a couple additional Inflation Reduction Act programs, 45L tax credits, and briefly mention 179D, which is a tax deduction. And as Ian mentioned at the end, we'll open it up for some questions and answers. So let's go ahead and get started. Renewable energy tax credit basics. So why are we talking about renewable energy tax credits today? Well, these tax credits provide an opportunity to create equity and kind of fill gaps by developing and constructing green technologies. So every developer I know is looking for ways to make their capital stack work, to make projects pencil, and this is just another opportunity, especially if you're already considering constructing and implementing green technologies, to really boost your equity in capturing these tax credits. So that's what we'll be diving into. I'm going to start at the very beginning with some renewable energy tax credit basics, starting with tax credits. What is a tax credit? Tax credits provides a dollar-for-dollar reduction in an organization's tax liability, which means tax credits really only benefit organizations with large tax liabilities. That means a nonprofit tax-exempt organization cannot really directly benefit from a tax credit because they're tax exempt. They don't have any taxes to pay, which is why credits are typically purchased by an investor or an organization with a large tax liability in exchange for equity to develop housing, which is at least in the LIHTC context. So that's what a tax credit is. We'll move on to renewable energy tax credits. This was a program created in 2005 and renewed in 2022 with the passage of the Inflation Reduction Act. It was created to help incentivize businesses to invest in green technologies. This program is specific to businesses. There's a very similar residential or homeowner program available, but the tax credits we're discussing in this presentation are the tax credits as described in Section 48 of the Internal Revenue Code and are specifically for businesses. And you are able to claim and earn tax credits from basis generated with eligible energy properties. And we can go into a little bit about what those eligible energy properties are. So most relevant to the LIHTC field, we see a lot of properties that install solar panels, solar hot water, and batteries or energy storage. There's an updated list of eligible energy properties, again, with the passage of the Inflation Reduction Act, which are listed on the slide. You can generate tax credits from fuel cell, microturbine, small wind, geothermal, waste recovery energy, biogas, and microgrid, just in case you wanted to know. I haven't seen any LIHTC deals with small wind farms on the site, but anything could happen in the future. So if that's what you're considering, you can still generate your renewable energy tax credit from that energy source. And just to do a little bit of housekeeping, as with everything in affordable housing, there is an abundance of terms and acronyms relating to renewable energy tax credits. So I think this slide is just to try to communicate that these are all the same thing. They're referred to as plenty of different things. You might see them called investment tax credits or renewable energy tax credits. But these are all tax credits as described in Section 48 of the Internal Revenue Code. We've been leaning towards renewable energy tax credits. That's what we're noticing a lot of our partners are referring to these as. So that's what we'll be referring to them as in this presentation. But again, if you see ITC somewhere, just know that we're talking about the same thing. All right, we're going to move right into a very basic calculation of this credit. After that, we'll talk about some rules regarding the credit, but I think it's helpful that folks see how the credit can be calculated and what you need to get there. So here's again, a very basic calculation, and we'll get into each of these terms in just a moment. So calculation is energy property basis multiplied by the taxable portion of the property or owner, rather, multiplied by the renewable energy credit percentage is equal to the tax credit you're eligible to receive. So let's dive into energy property basis. So this is basically, when I say property basis, I really mean costs here. And this is made up of hard costs plus soft costs related to the energy property work. Just a quick refresher on those terms. Hard cost is the cost of labor and materials needed to install the system. You go out to, get a couple bids from solar installers. They're going to provide a quote that includes labor and materials, and that's what we're going to be using as our hard costs. For soft costs, these are all kind of the more squishy costs: design, engineering, permits. You can even make the case that there's some construction loan interest attributable towards cost of the system. Those can also be included in this calculation to generate renewable energy tax credits. The hard costs are pretty straightforward. The soft costs, must be reasonable. And typically, when you're calculating this credit, it's good to reach out to your CPA just to make sure they're on board with the cost you're presenting and calculating the renewable energy tax credit. As I mentioned, if you have a large construction loan, you're developing a large property, you can make the case that some of that construction loan interest is you can use towards this. Other things could be insurance. I wouldn't go too far out if possible, but at the same time, you don't want to leave costs on the table. So in our example here, let's assume hard costs or the cost of the PV system equals $850,000. We have soft costs of about $150,000. So let's just say that the total energy property basis is worth $1 million. There we go. I'm going to acknowledge taxable portion. We're going to get into this a little bit in a little bit more detail further in the session. So I'm going to skip over this for the time being and just assume that in this example, we're able to claim 100% of taxable portion towards this calculation. So moving on, the renewable energy tax credit percentage. Let's take a look at what that means. So prior to the Inflation Reduction Act, this credit percentage was in a step down phase. And we'll get into that, I think, a little bit more. But right now, with the passage of the Inflation Reduction Act, we've brought this, or the IRS has brought this credit percentage up to 30%. There's a quick caveat, though. The 30% credit rate is only applicable if either the system net output is less than 1 megawatt, or if the system net output is greater than 1 megawatt, the developer must meet prevailing wage and apprenticeship requirements. And just know that there are credit bonuses available, and we'll cover those. If a system is greater than 1 megawatt and doesn't meet the prevailing wage and apprenticeship requirements, your credit rate drops to 6%. So from 30% to 6%, which is an 80% reduction. So that's very important to confirm. Just for a sense of scale, 1 megawatt can generate enough electricity to meet the needs of 160 single-family homes in the US. So I've personally never worked on a project that had a system greater than 1 megawatt. Certainly feasible if you're doing a master development of something of the like. So it's always good to confirm, with your engineers and designers to see the system that you're proposing to make sure you kind of fit within that box. Just know that 1 megawatt is a fairly large system, and it's pretty uncommon in our LIHTC world. So here's the calculation. $1 million multiplied by 100%, multiplied by 30% leaves you with a $300,000 renewable energy tax credit. And just a reminder, this tax credit is not equity. This tax credit is a dollar-for-dollar reduction in tax liability. In the LIHTC world, this credit is typically purchased by an investor. If you have a LIHTC deal and you're also considering renewable energy tax credits, typically seeing the investor purchase both. There are some new avenues that were passed by the Inflation Reduction Act where the owner can sell this tax credit on the third market, or to an outside party rather. And we'll get into that in a bit, but typically these are purchased by the investor. And a nice thing about the renewable energy tax credits is you can mostly claim the credit up front. For LIHTC, it's over a 10-year period. So this makes this credit a little bit more appealing. I've typically seen investors purchase these credits at the same price that they purchased LIHTC. But you can make the argument, given the investor is able to take these credits maybe a year or so after placed in service, that they might be more valuable. All right, so again, the majority of this presentation will cover some of the new rules and existing rules as they relate to renewable energy tax credits. So let's talk about the solar credit phase-out schedule. So prior to this legislation, we were actually in the middle of a phase-out schedule. For projects that began after 2020, we were only able to take a 26% credit. And if this legislation wasn't passed for projects starting after January 1st, 2023, the credit percentage would have dropped to 22%. However, it passed. So now we get this nice 30% credit rate until 2032. So for about 8 more years. And then there will be a similar step down period after that, but 8 years is a long time. And for that time, we'll be able to take advantage of this 30% credit rate. And again, there's that quick asterisk that says systems must be below 1 megawatt, or else that 30%, that nice 30% gets reduced to 6% and really devalues the credit. Some other rules, renewable energy tax credits no longer requires reduction in LIHTC eligible basis. So that was an old rule that devalued the credit a bit. It's usually, in a couple examples, I've seen that kind of reduce the value of the credit by 10, 15, 20%. If we had more time, we could kind of go into a quick calculation on what that looks like, but just know that that's no longer required, and we can essentially now double dip the basis generated from the solar for both low-income housing tax credits and renewable energy tax credits, which is my second bullet point here. So that, again, that one, in our example prior, that $1 million can be used to generate both low-income housing tax credit basis and energy property basis to generate renewable energy tax credits. So if you, and we'll do a couple of slides on what that could look like later, but you could almost offset, if not more than offset, the cost of the system by generating tax credits to pay for it, which is a pretty cool feature. We're going to be spending a lot of time on credit bonuses in these next slides, and then we'll talk about these new avenues to not claim the credit, but to transfer the credit and other ways to take advantage to utilize the credit. All right, well, let's dive into the bonuses. This is a very broad overview of the different bonuses that are now available. And these are bonuses to the credit rate, right? Remember, we have the 30% base. And then if we hit either bonus that are presented above, we can increase that rate to either 40, 50, or even up to 70%. So there's the domestic content bonus, there's an energy communities bonus, both are for 10%. And then there's a new environmental justice bonus for projects located in low-income communities on Indian land, or if they qualify for low-income residential building projects or low-income economic benefit projects. And we're going to go into details on what that means. Again, I said some bonuses are stackable. Each of these three bonuses are, you just cannot stack bonuses within the environmental justice bonus, right? So you can only choose one of these subcategories for that environmental justice bonus. All right, let's talk about domestic content bonus, which is the first bonus that we presented on the slide before. So this provides a 10% credit boost for manufactured projects, which are components of a qualified facility. This bonus is as of right, so there's no competitive process required. And I've included a table, I think I took it from the Department of Energy website, kind of telling you the required percentage of domestic content needed in order to take advantage of this credit boost. What I've heard from folks is that, it's kind of pricey to hit these domestic content requirements now. They may come down in the future, and I think that's why it's included in this legislation, is to motivate folks to buy domestically and get the domestic supply chains going, so that that incentivizes folks to purchase domestically. So maybe not worth it now. The cost of buying the domestic content might outweigh the boost you receive from the bonus, but in future years that might not be the case, and so this is something to definitely look for. So that's the first bonus. The second is for projects located in energy communities. So there's a 10% community or credit boost for projects located in energy communities, as defined as projects located in a brownfield site, projects located in metropolitan statistical areas or non-metropolitan statistical areas where fossil fuel industries contributed significantly to employment and that have an unemployment rate at or above the national average. And the last qualifier is projects located in census tracts in which either a coal mine or coal-fired power plant has recently retired. Luckily, there's a map available on the Department of Energy website so that if you plug in your address, you will quickly find out if you apply for this energy bonus. I've taken a snapshot of that map and put it here on the slide. You'll notice that a large amount of Los Angeles County is included within an energy community. It unfortunately kind of cuts off up top. There isn't as much, there aren't as much areas that are energy communities in Northern California, but still worth checking to see if you can qualify. And again, this bonus is as of right. There's no competitive process required. All right, that takes us to environmental justice bonuses. And there's kind of a lot to cover here, so bear with me a bit. So let's start from the top, okay? Applicants investing in certain eligible solar and wind facilities that are less than 5 megawatts may apply for an allocation of bonus. Notice I highlighted or I bolded the word apply because this is now a competitive process to obtain an environmental justice bonus. You have to actually submit an application within a portal that was set up by the Department of Energy, and it's not by right anymore. Further eligible facilities include wind, solar PV, solar hot water, and energy storage technology or batteries. So this is just a subset of the eligible facilities that we talked about earlier that are applicable for this environmental justice bonus. For the calendar year 2023, the total annual capacity limitation of 1.8 gigawatt will be divided among 4 categories. And these next couple of slides will explore each category. So category 1 are for projects located in low-income communities, in which you'll get a 10% boost. These are broken up between residential behind the meter facilities and residential front of the meter facilities in commercial buildings. Category 2 is for projects located on Indian land, which provides a 10% boost. Category 3 is for projects that are qualified low-income residential building projects, which is a pretty hefty 20% boost. And lastly, category 4 is for projects located or projects that are qualified low-income economic benefit projects for a 20% boost. So if you add up all of the allocated amounts here, you'll get to the 1.8 gigawatts, which has been allocated for 2023 and for this year, 2024. After this year, any excess may be carried forward to 2025 if there is any excess. But the legislation only funded 2 years worth of these bonuses, and we'll have to wait and find out if they plan to fund more. So given 2023 was the first year, we have some information from the first round of results. These applications were due on November 18th, and the IRS and Department of Energy received over 46,000 applications for this specific bonus, representing over 8 gigawatts of generation capacity. So very oversubscribed, right? 1.8 gigawatts available, 8 gigawatts worth of projects submitted. The IRS is still, or Department of Energy is still in process of reviewing and making awards. If you go to their website, they actually have a pretty nice little table that shows you how many awards that they've made already, what kind of applications are still pending, and the total applications or amount of applications that have been submitted. So let's take a closer look at this environmental justice bonus. Category 1, projects located in low-income communities. This is a 10% credit boost. So this has a specific definition, which is outlined here. Any census tract with poverty rate at least 20%. For tracts not located within the metro area, the median family income does not exceed 80% of statewide median income. And for tracts located within the metro area, median family income for such tract does not exceed 80% of statewide median or metro area median income. Again, we don't have to really do a lot of research to see if our project qualifies because there is a map available, which is represented to the left of this slide. This is also the same definition the IRS uses for new market tax credits. So, if you're interested in this bonus, feel free to take a look at the map, see if your project is located within one of these communities or areas, and you can take it from there. This just tells you how much megawatt capacity is available, and breaks out the different designations. For the majority, the 490 is for eligible residential behind the meter facilities, which include rooftop solar. The remaining 210 megawatts would only be for applicants with front of the meter facilities. And then moving on to category 2, which is projects located on Indian land, and that means on land located within the boundaries of an Indian reservation, pueblo, or rancheria. There's 200 megawatts available. And I recall on the website, I don't think this was one of the only categories that was undersubscribed, so there might be some capacity left for this bonus if folks are available in that. All right, this is kind of gets into the weeds here a little bit, so again, bear with me. For category 3, for qualified low-income residential building projects, in order to be eligible to apply, the residential rental project must participate in a federal covered housing program, which is a pretty wide list, right? This includes low-income housing tax credits, HUD 202s, 811s, HUD Home, USDA 515, project-based Section 8, and this is only, just a sample of the list that's included. So really any federal covered housing program should qualify, which is most of the projects that we work with over here at the partnership. So that's the first criteria. Second criteria is that the financial benefits of the electricity produced by such facility must be allocated equitably to the occupants of the dwelling units. So you need to give the benefits produced by the solar back to the tenants. Now, there's 2 ways to do that under this category 3. The first way is that tenants can receive a financial value associated with the utility bill savings in the form of credit on their utility bills. So that would, of course, involve working with the utility to provide that credit. If that's not possible, that makes more sense if you have a sub-metered building and each resident gets an individual bill. If that's not possible, or maybe the utility is just not willing to work with you, and if you have a master metered buildings, you still need to pass on the savings, but you can do it through other means, such as providing certain benefits to the building residents beyond those provided prior to the qualified solar and wind facility being placed in service. So the IRS has a list of different benefits that I've included here on the slide. That could include job training and workforce development, facility upgrades, wellness programs or services, free or reduced Wi-Fi, financial literacy, I can't speak today, additional staff support, shuttle services, gift cards, cash payments. So a whole kind of list, but there needs to be a service provided, and you need to give back the benefit from the solar directly to the residents. So how much do you need to give back? Well, there's 2 different categories. This is the benefits calculation. So for projects where the energy facility and property have the same ownership, financial benefit is described as the greater of 25% of the gross financial value of the annual energy produced, or the gross financial value of the energy produced minus the annual operating costs to operate the solar facility. It differs a little bit if for folks that have a different ownership between the energy facility and property. In that case, the financial benefit is described as the greater of 50% of the financial value of the energy produced, or the financial value of the annual energy produced minus the payments made by the building owner to the facility owner. And I forget if I mentioned, but that's the greater of for each of those benefit calculations. So that's a lot. I mean, you're able to take this credit. It's a very hefty credit. It's 20%. But if you do take it, just know that you're going to have to give a lot of the benefit back to the residents, which, you know, very well could be the right thing to do. Just know, don't expect to take this credit and expect it to completely offset your operating expenses of your community room or of the office, because that's not the way it works. There's that added stipulation where the benefit needs to go to benefit the residents. So category 4 is similar, as there is that component of giving back the energy to the occupants. However, it doesn't require that you're covered by a federal program. It does require that at least 50% of the financial benefits of the electricity produced are provided to the households with incomes of less than 200% poverty line, applicable to a family of the size involved, or that they're less than 80% AMI. This also doesn't allow you to kind of do the other benefits. This category requires that the benefit must be linked to a household's utility bill. You can't get by providing free Wi-Fi or job training or any other kind of soft benefits as described in this category. And then this is just a baseline that you need to meet. It must provide at least 20% bill credit discount rate for all such low-income households. And the bill discount rate is the difference between the financial benefit distributed to the low-income households and the cost of participating in the program, expressed as a percentage of the financial benefit distributed to low-income households. So that's an overview of the 4 different subcategories that makes up the environmental justice bonus, which is a competitive bonus. Here's some additional rules. So because it's competitive, the IRS has outlined some preferences. So for folks that have ownership criteria that are qualified tax-exempt entities that are tribal, Alaska Native, renewable energy cooperatives, they will get preference in receiving an allocation of environmental justice bonuses. Sorry, I think I skipped the first bullet point here. So 50% of the capacity limitation in each facility category will be reserved for facilities meeting these specific ownership and geographic criteria. So that's a pretty good limitation. There's a geographic preference for facilities located in persistence poverty counties and census tracts designated within the climate and economic justice screening tool as disadvantage. And then some other miscellaneous rules here. Energy facilities placed in service prior to an award are not eligible to receive an allocation. Only the owner of a facility may apply. And then applicants may only apply in one category. Facilities that qualify as category 3 or 4, which I would imagine the majority of the LIHTC deals would fall under one of those categories, must apply under category 3 or 4. So you can't try to get the low income boost, communities boost of 10%. You really would have to go for either the 20% boost that's described in category 3 or 4. Okay, so let's see, kind of do a quick calculation on what these boosts might mean for you. And it's pretty simple, right? If we're moving from the base of 30% to, say, we get the energy communities bonus, which would be a new total of 40% because you get that 10% boost. That would bring your renewable energy tax credit up to $400,000. Further, if you were to combine the energy communities boost with the low income bonus that we just described, which is a 20% boost, that would bring your credit percentage up to 60% and generate $600,000 in renewable energy tax credits. So that would be double what the base rate would provide for you. And here's a quick representation of what that double dipping might look like, right? So we have energy property basis of $1 million, And again, that can be used to generate both the renewable energy tax credits and the low-income housing tax credit. So in this scenario, we're assuming a 60% credit percentage. We're assuming the property is located in an energy community and receives a low-income bonus. That would generate $600,000 of renewable energy tax credits. But also, we could use that same $1 million to generate low-income housing tax credit, low-income housing tax credits, which, this is a very simple calculation, but we can kind of place that somewhere around $400,000 of those types of tax credits. So 600,000 in renewable energy tax credits, 400,000 in low-income housing tax credits. That's $1 million of tax credits that was obtained by developing a $1 million solar system. So depending on what you can get for what someone's going to purchase those tax credits for, you're going to be very close to offsetting your cost of developing solar on your project. So these rules, these are new rules to help developers utilize renewable energy tax credits. The first is elective pay, which allows tax-exempt and government entities to benefit from renewable energy tax credits by treating the amount of credit as a payment of tax and refunding any overpayment. So remember what a tax credit is. It offsets owner's tax liability because government entities and tax-exempt organizations do not have any tax-exempt entity. This credit wouldn't really provide any use to them. In the old rules, the owner couldn't sell it. They would have to claim the credit, and it wouldn't help out these entities at all. So now the IRS is saying, okay, well, you can use it through just showing this in your tax filing, and then we'll count it, as a payment, and then we'll refund you the overpayment. So it kind of opens up the avenue for tax-exempt and government entities to benefit from investing in green technologies. Similarly, for taxable entities, they can now transfer all or a portion of the tax credits to an unrelated third-party transferee in exchange for cash. So say you're a taxable entity and you just don't have a lot of tax liability you need to pay for, and you've done this huge, green system, if you otherwise wouldn't be able to really claim, fully utilize that tax credit because you just didn't have the amount of taxes necessary to fully benefit from it. But now this guidance is saying you can sell to an unrelated third party in exchange for cash. So there's markets available now where these credits can be sold to big investors or banks, which have that huge amount of tax liability and are more valuable to them. So really just trying to expand the usage of this program under these two. And here's a quick chart from what I just described. Tax-exempt entities are eligible for direct pay. Taxable entities are eligible for transferability, but not the other way around. All right, so this all sounds pretty great, right? If you're developing solar technologies on your property, why not claim this credit? Well, there's one kind of pesky issue that we run into time and time again when we're considering this tax credit, and it's worth talking about in a little bit more detail. So let's just dive in. We saw in the previous slide that both tax-exempt and taxable entities can take advantage of the renewable energy tax credit through direct pay or transferability. But what about typical LIHTC deals, which involve an owner-limited partnership comprised of both a nonprofit general partner and a taxable investor limited partner? So because of that complicated structure, we run into some issues there. Limited partnerships do not qualify for renewable energy tax credits to the extent that there's any tax-exempt use property. So what is tax-exempt use? Well, let me try to explain that a little bit for you. And we're kind of getting into the weeds with tax concepts here, so just hold steady while I try to get through this. Nonprofit GPs can benefit from special allocations of tax attributes, which can include profit and loss, cash flow, and sales proceeds. Nonprofit GPs like to elect for special allocations of cash flow and sales proceeds up to 90%. So let me take a step back. So a nonprofit GP can say in their limited partnership agreement that they can capture 90% of any cash flow that the property obtains during operation, and they can take 90% of any sales proceeds upon year 15, which is a great benefit for the nonprofit GP, and the investors have kind of go along with it. They don't mind too much. However, in order to make that designation, they are considered, the limited partnership is considered 90% tax exempt use, or 10% taxable use property. So what does that mean for your calculation here? Remember this taxable portion of the calculation we went over earlier. If we were to hang on to those favorable tax attributes, we would lose out on a lot of the renewable energy tax credit we would be otherwise able to take. So here's my example. For special allocations, you can see that we have to reduce our taxable portion by 10%, which reduces our credit by $30,000. I'm sorry, reduces our credit to $30,000. So that you just lost 90% of your incentive to request these renewable energy tax credits. Now there's a way around it. So there's qualified allocations where the limited partner can take 99.99% of all of these tax attributes of the cash flow, the sales proceeds, and the profit and loss. And taking that designation, we would consider the organization, the limited partnership, to be 99.99% taxable use property, which is great for your ability to capture renewable energy tax credits. You can see here that only just a little bit is shaved off because we're 99.99% is so close to 100. But at the same time, the general partner would have to forego the favorable treatment of cash flow and sales proceeds. So there's a trade-off if you want to capture these. And these risks and trade-offs really depend on a case-by-case basis. So here's two options to avoid tax-exempt use restrictions and renewable energy tax credits. I'm not going to get really too far into these. I just want to highlight them to know that there is a trade-off. And if you're considering renewable energy tax credits and you're a LIHTC deal in the early stages of development, to have this conversation with either your financial consultant or your tax attorney to figure out if these might pencil for you. So again, qualified allocations where the limited partner gets most of those tax attributes, which we just discussed. It's easy to designate. We just include that within the limited partnership agreement. But again, the cons that we discussed, the LP retains 99.99% of the cash flow and back-end proceeds. So the risk to the GP is very much case specific, including cash flow, waterfall, and cash sweep options, as well as the year 15 economics, including outstanding debt versus fair market value and potential for substantial reserves remaining. So if fair market value is higher than outstanding debt, that could create problems. If not, maybe it's not that big of a risk. Maybe it's not that big of an issue, especially if you have, minor reserves. So again, it's very case specific. And if you're talking about a large renewable energy tax credit, in the hundreds of thousands that you need to bridge the gap, or you need to make your project pencil, then we do have to consider that and kind of weigh these different options. The other option in this, I don't know if this has been tested yet, at least on our side, but there's an option to make an 168H election, which considers the general partner taxable entity for federal tax purposes. The pros of that designation is that the GP can retain 90% of the cash flow back in distributions. But the cons is that now your general partner is a taxable entity and is subject to capital gains tax and a whole bunch of other issues. So this, again, is very case by case. What could go wrong? Your nonprofit is now considered a taxable entity, which opens up a whole can of worms. So yeah, you really have to think about these implications and work with folks, in the know to determine what makes the most sense for your project. All right, stages of development. I'm just going to quickly highlight a couple of stages and what you have the most flexibility. So we talked about, and I think most of this presentation kind of had in mind a new construction project where you're in the early stages, you have a lot of flexibility to consider the structure, to consider your tax use structure, and you can pretty much make whatever election you want in order to take advantage of the renewable energy tax credits. If a project is in the compliance period, right? So the project has been completed, you have an investor kind of hanging out, and you're between year 1 through year 15. If you're considering these renewable energy tax credits, I think the first thing you probably need to do is to determine where you are with your tax exempt use ownership structure to try to avoid that issue, right? Because if you might not be able to claim the entire potential tax credit if you do have that issue to work through. But you could potentially consider some creative solutions. One that is theoretical, we haven't seen it come through, but potentially you could have the solar property that's directly owned by the nonprofit sponsor, and that the sponsor could elect to have direct pay option. There's some transactional costs. There's some timing issues to consider. But it's a potential, and I thought I'd throw it out there if folks are really gunning to try to make that work. And of course, if the investor's exited and the property is owned by a nonprofit general partner, then the direct pay should be a slam dunk, right? Because you have a tax exempt entity that owns the project, you develop the solar, and then you can do that direct refund through your tax returns to claim the credit and to get paid for that rebate. All right, I know I'm kind of running out of time here, so very briefly, I'm just going to describe 2 other benefits. 45L credit is called the Energy Efficiency Home Credit Program, which provides up to $5,000 a unit if the eligible development meets certain energy efficiency and federal prevailing wage requirements. So this was expanded by the IRA by extending the credits through 2032. It also increased the credit amount. Some miscellaneous provisions is that there is a certification process required. This credit is not eligible for direct pay or transferability. The credit is as of right, and it is stackable with renewable energy tax credits. So if you already have a green pathway forward, which involves energy upgrades throughout, or new construction energy upgrades, and you want to pair that with the renewable energy tax credits, you can, and you can get tax credits for both programs. And real quick, we've heard from a couple different developers to see if 179D might be beneficial towards their project. I just want to remind folks that 179D is a tax deduction, and that being the case, it reduces LIHTC basis, so it doesn't really make it too advantageous in the LIHTC realm. There is a passage, a newly created passage, that allows tax-exempt entities to transfer this tax deduction to their design team in exchange for reduced design services. But again, because we're dealing with limited partnerships, which are made up of nonprofit, tax-exempt general partners, and taxable investors, it's unclear if that provision is applicable because it's not, the organization is not just a tax exempt entity, it's a mix. So I haven't seen any take advantage of that passage of the benefit over to a design team, but there is that new guidance out, legislation out. Okay. Sorry, I covered a lot of very technical information, and I think I went over a little bit, so my apologies there. I'm going to open it up for questions, and I don't know if Ian or Angel, if you have a process you want to run through in taking and answering questions.
Yeah, so if any folks have any questions they'd like to ask before the end of the session, definitely feel free to add them in right now into the Q&A box. But Jesse, so far we have one question. Is when do you apply for these bonuses relative to start of construction?
Sure. So last year in 2023, there was a 30-day window where you were able to apply, and that was between October and November. Now, 2023 is, like I mentioned, is oversubscribed, but there's going to be another portal application process for 2024. My assumption it's going to be in the same time period, so it's going to be a 30-day period between October and November, where the Department of Energy portal will be active, and all applicants that submit within that time period will be processed at the same time.
Thank you. And then next question, I'll hand it over to Ian. How do I receive the PowerPoint presentation for this webinar and the previous one?
Hi, Crystal. The webinar slides will be sent out after this. The previous one should have already been sent out. If you want a copy of those, feel free to email me directly if you haven't received them. My email is isharples, SHARPLES at chpc.net. I'll be happy to get them to you.
Next question, is battery storage covered under 45L? Hand it over to Jesse.
Can you repeat that, Angel? I'm sorry.
Yeah. So is battery storage covered under 45L?
Maybe they mean battery storage. And I don't believe so. I think there's very specific requirements that are outlined in this guidance that need to be met for you to claim these credits. There's a lesser tier where the project meets Energy Star multifamily. And those, if you're paying Davis-Bacon prevailing wages, you're able to get to $2,500 a unit. To get to the max 5,000, you need to adhere to the DOE Zero Energy Ready Homes program. So you have to hit the requirements outlined in either program to be eligible. So I would take a look at what those requirements are and see if your project might be a good fit to be eligible for this credit.
Looks like there's a slight addition from Tony. They're referring to on-site PV. I don't know, does that change anything if the photovoltaic is on-site?
I'm not sure. I would have to kind of review those programs in a little bit more detail. I don't have that information off the top of my head, unfortunately.
And then I'm noticing another comment from Melissa about the slides from the last presentation. Yeah, I think we'll try to work on that since it seems multiple people didn't get them. Yeah, we'll try to get a link posted for you and then get that sent out.
So I know we're kind of running short on time. Are there any last final questions, thoughts, maybe comments? If not, I think we'll be ready to close off today's webinar session. Hand it over back to Ian.
Cool. Thank you, Angel, for helping with the Q&A. Thank you again, Jesse, for your wonderful presentation. Really, really excellent information there. And then finally, thank you again to our sponsors, Wells Fargo Foundation and the Building Initiative, for low emission design. Give them both a look and give them some love. So yeah, we want to remind everybody about our final session next Wednesday, the 14th at 11:30. Again, if you registered for this, you're registered for that. So just click on the same link and you should be good. So thank you again, everybody. Thank you also, Hilda and Sierra, for helping support this. And I think that should be it. Awesome. Have a good day, everybody. Bye bye.